So good morning, everybody, and welcome to the first quarterly bulletin of 2016. I just want to introduce my colleagues, Gabriel Fagan, Chief Economist, Luca Onoranti, Acting Head of Monetary Policy, and we'll be joined during the briefing by John Flynn, who's just been delayed. So we'll kick off shortly with the briefings. I'd just like to introduce for this particular briefing that we are recording it, including the questions for our YouTube channel. So just be aware of that if you're asking any questions. And in addition to that, we've published a number of YouTube videos today related to the briefing with the participants from the briefing, and also Niamh Hallisey, who has a published article in the bulletin. So please check those out afterwards and let us know your feedback. So I'll hand over now to Gabriel. Thank you.
Shall I start?
Oh, yes, please, yeah.
Thank you very much. Good morning, everyone. I will just say a few words about the part of the bulletin related to the European and international environment. We have three main messages I would like to highlight. The first one is that the recovery continues in the euro area. It's been now 2 years and a half. It's a gradual recovery, but it's persistent. The second message, that inflation remains, despite this, very low, actually very close to zero, and this is partially owing to oil price developments. And the third part is more about risks, and it seems that the external and international environment is the key risk to the economic outlook in this phase. I would also like to attract your attention to two boxes in this part of the bulletin. The first one is about understanding credit developments through comparing firms and bank surveys. So here is information on both sides of lending, both qualitative and quantitative, about successful loans, in order to understand better what happens. And the second one is about non-standard monetary policy, corporate lending, and the balance sheet channel. It's about basically how a monetary policy works or is impaired in getting through loans. Let me start with GDP. As said before, the gradual recovery is at the moment on track. The latest data are from 2015 Q3, and it's 0.3% growth quarter on quarter. This growth, as you can see from the very last column on the right, is mainly supported by private and public consumption. Private consumption basically given by higher wages and lower unemployment rates, and public consumption is given by government expenditure. And inventories also constitute a policy contribution. Where we don't see a positive contribution is in investment, which remains subdued despite the very favorable financing conditions in the euro area overall, and net exports. This due to a less favorable global environment. The factors that support the recovery at the moment are several, but I would like to highlight three of them: the low oil prices, the external value of the euro, which remains relatively subdued, and the very accommodative monetary policy stance of the European Central Bank. Turning to inflation, you have here two charts. On the left side, you can see euro area inflation here. Headline inflation has been hovering around zero recently. The latest data from December at 0.2% year on year. And this is, of course, far from the price stability objective of the ECB, which is 2% close but below 2%. This is partially, and you can see it on the right side, due to oil price and energy developments. And it's happening despite the accommodative monetary policy stance of the European Central Bank. It seems like the monetary policy is at the moment very helpful as far as financial conditions and asset prices are concerned, but it doesn't seem to reach full inflation yet. This could be done to different factors of impairment. For example, the existence of a lot of non-performing loans still, the fragmentation in the financial sector, and the deleveraging efforts that are ongoing from firms and households. I would directly move to the risk to the outlook. The key risks to the outlook are linked to the external environment. First of all, we have a disappointing external demand, and we do expect this to continue, notably from large emerging economies. Second, the monetary policy in the United States has been slightly tightened, and there are expectations that to some extent this may continue. So this decoupling between United States and emerging markets may be a factor of tension insofar as some of them are heavily dependent on the dollar and on the interest rate of the dollar. In particular, all the eyes seems to be pointing these days to the Chinese economy. There is a concern that lower than expected growth may have a negative effect on global trade, and that the depreciation of the Chinese currency, the renminbi, can actually make the euro-denominated product less competitive. It's a news of this morning that the Shanghai Stock Exchange yesterday has lost 6.5%, so this is a factor to keep into account and in mind. On a more positive note, the recovery continues to be supported by the factors mentioned before: low oil prices, a weak external value of the euro for the moment, and the accommodative policy, monetary policy stance. Inflation remains very low, and this is due partially to oil prices. And one of the risks is that actually inflation expectations may also be subdued or partially desanchoring. This would be a more problematic factor. Let me finish with some forecasts for the euro area. I will concentrate, you can see the numbers here from several institutions. I will concentrate on the numbers of the Eurosystem staff BNP projections of December. For 2015, we don't have all the data, so we have to nowcast or forecast it or backcast in this case. We foresee 1.5% growth, which will become 1.7 and 1.9 in 2016 and 2017 respectively. HICP inflation has been 0.1% in 2015 and is expected to grow to 1.0, not 10, in 2016 and to 1.6 in 2017. Again, these numbers are probably subject to downward risk. In particular, prices are subject to several risks. The first one is that the oil pass-through through energy prices and prices may not be complete. And the second one could be that there may be second round affected through wages and expectations. Thank you very much.
Sorry, thanks. I'll just take the...
sorry.
Cheers. That's great. Thanks very much for that, Luca. Turning to the Irish economy and the outlook for the Irish economy, the main message from the bank's latest forecasts is that a convincing economic recovery is now well established, and that the outlook for the economy for this year and next year, for 2016 and 2017, is broadly favourable. So, following strong growth last year, the latest forecasts that we have now project that GDP will grow this year by around 4.75% and by slightly less than 4.5% next year. We've seen growth accelerate and broaden significantly over the last 12 to 18 months, and increasingly the growth has been driven by a significant rebound in the domestic economy. Recovery has benefited from a couple of things, and it's benefited both from the stabilising influence of the policy and macroeconomic adjustments which have been undertaken, as well as the coming together of a fairly broad set of favourable factors which have reinforced each other to support growth. And in particular, we can look at these as follows. So there's been a stimulus to incomes which has come from an employment-rich recovery. We've seen fairly strong employment growth for a number of years now. And this has been reinforced both by the emergence of wage growth over the past 6 to 12 months or so, and also by the boost to purchasing power from lower energy prices, because we saw a pretty significant fall in energy prices last year. Growth has also benefited from a more benign policy environment, and that's been reflected both in the easing of the scale of fiscal consolidation and also in continued favourable financial conditions. And I mean, a particularly important one which has helped to stimulate the economy has been the exchange rate and exchange rate movements. And additional support then has also been provided by the ongoing improvement in household and firm balance sheets, and also what up to now has been continuing favourable conditions in our main export markets. So essentially it's been the positive alignment of all those factors, many of which have acted to boost domestic demand, which have come together and helped growth to strengthen. And looking forward, as we would expect a good number of those to be maintained, it supports a continued favourable outlook for the economy. Now, as Luca has pointed out, the international environment has changed and is changing kind of more recently. And we are seeing rising global risks. And these rising global risks are a threat. And should we see lower growth in trading partner countries than is currently forecast, or if tensions are were to persist in financial markets, then there could be some downside risk to the outlook. So turning now to the detail of the numbers, sorry, just go forward one. So if we look at the detail of the numbers, well, we still are waiting for national accounts data for the final quarter of 2015. Kind of on the basis of what we have, kind of and our view on the year, we estimate that GDP grew by sort of close to 6.75% last year. For 2016, our latest forecast, as I said earlier, is for the economy, is for GDP to grow by 4.8% this year. And that's broadly unchanged from the number that we published in the last bulletin. It's up marginally by 0.1%. And as was the case in 2015, we expect that the domestic side of the economy is likely to be the main driver of growth this year. Now, there are risks to the forecast, and I'll say a little bit about those a little bit later. If we look at consumption, last year consumer spending grew by 3.25%, which was the fastest rate of growth in consumer spending since 2007. And while some of this growth was a catch-up for the weakness of consumer spending in earlier years, the main driver of the pickup in spending essentially was the growth in employment and incomes, because as I said, we saw fairly solid employment growth. We've seen it for a number of years now, and we also saw growth in incomes on the back of that, and also on the back of some wage growth. So with employment likely to continue to grow strongly this year, we expect employment to grow by almost 2.5% again this year. For that to continue into next year at maybe a slightly slower pace. And with wages starting to rise again, income growth, combined with the relatively high levels of consumer confidence that we see, should be sufficient to boost spending. And there may also be some boost from the kind of lagged impact of what's been happening to energy prices and what has happened to energy prices over the last while. So taking all these things into consideration, we expect consumer spending to grow by almost 3% this year, so just under 3%. Looking at investment, as you can see from the table, the level of overall investment grew very strongly. This year it was, last year it was exceptionally strong in 2015. But the overall level of investment, as we know, is distorted by the impact of investment in aircraft and also the transfer of patents into Irish entities by some multinational corporations, which increased significantly last year. Now, if we abstract from those two categories and we look at kind of what you might consider underlying investment, net of aircraft and intangibles, it's growing pretty strongly. The Q3 numbers, I think, pointed to growth of around 10% or so in that measure. And looking ahead, the broadly favourable economic outlook that we have, combined with the fact that underlying investment levels are still recovering in some sense from what happened in earlier years, suggests that the outlook for underlying investment is broadly favourable. So we see that continuing to grow. And this will help to bring the share of that measure kind of back in terms of GDP, kind of back towards its long-run average. Now, I point out that the overall investment forecasts come with a strong caveat because, as I said, both aircraft purchases and R&D investment flows and patent flows tend to be volatile. Now, on the one hand, both of these categories of investment lead to corresponding increases in imports. So the overall effect of this volatility on GDP should be offsetting. And so basically, as we see changes in investment, it should be reflected in changes in imports. But what it does do is it introduces a high degree of uncertainty to the forecast for both investment and imports. So it's as well to bear that in mind. If we look at the export performance, again, exports performed fairly strongly last year. And what was significant was that we saw very strong growth in goods exports. And that reflected, and it was goods exports from Ireland, so it wasn't where it had been previously contract manufacturing before. It wasn't contract manufacturing to the same extent, but the main drivers of those exports kind of came from a reflection of the increased output in the pharma sector, so it was partly pharma exports. But significantly also we saw strong growth in exports of indigenous sectors such as agri-food and tourism. And that was helped, I suppose, partly by exchange rate developments and for some sectors by favourable demand conditions in trading partner countries and also by the impact of lower energy prices in some cases. Looking ahead, kind of our projection is that export growth will come more to reflect demand in trading partner countries. So it should return to more normal levels over the forecast horizon. But we see exports growing pretty solidly next year and that growth moderating again next year. So it will be a function of things like demand in trading partner countries and obviously will depend on what will happen there. It will be helped partly by the exchange rate and the impact of the domiciling of intellectual property assets here then may have an impact over time as well. If we look at sentiment indicators, the PMIs on the export side kind of remain fairly strong. So export growth should stay fairly solid this year, and we see it then kind of gradually moderating. We published our first numbers for 2017 in these forecasts as well, and looking at 2017, the outlook is for, we think, for growth to moderate a little compared to 2016. That's partly based on a view that we kind of expect the domestic side of the economy, growth on the domestic side, to gradually moderate. And partly that we expect essentially the net export side made no contribution to growth in 2015 or very little. And we see that gradually increasing over the forecast horizon. So we see the return of some net export contribution, but essentially growth will still be mainly driven by domestic factors predominantly. So anyway, inflation has been pretty moderate and we forecasted to stay pretty much that way. There's two offsetting things here. Goods prices have kind of continued to fall, so goods prices inflation has been negative, and we see that kind of slowly returning to stabilise and gradually increasing. Services price inflation has been rising. Our forecast for this year is for HSEP inflation of about 1% or so, but lower oil prices could have some bearing on that. So depending on how things play out in energy markets. Now, in terms of the balance of risks to our forecasts reflect really what we think is the most likely outcome for growth of the economy, but obviously there are some downside risks to growth. And on the other side, on the domestic side, you could say there may be some factors which could be potentially more positive. I mean, on the downside risks to the international outlook obviously are rising. And as I said, were global growth to be weaker and growth in trading partner countries to be weaker than might be expected at the moment, then or were financial market tensions to persist, then those things would have some downside risks to the forecasts. On the other hand, the domestic dynamic has been pretty strong. And the domestic side of the economy has been performing fairly strongly. So there is the potential for some more upside there. But at the moment, obviously, the focus is on what's happening at the international level. We also have some labour market numbers as well. And I'll say a little bit about what's been happening in the labour market, because what's been happening in the labour market, as I said, has been an important driver of what's been going on the domestic side of the economy. As you can see from those numbers in terms of employment growth, the recovery in the labour market has been going on for several years now and has been pretty strong. And 2015 saw some further gains. So the employment has grown pretty strongly over the past year. The overall level of employment is now about 8.5% above what was the trough reached in the middle of 2012. And the unemployment rate has fallen fairly significantly from that period as well. So we now have an unemployment rate down at 8.8%. Kind of as has been the case for some time, kind of it's a pretty broad-based growth in employment. And that is pretty broad-based across the private sector. So more or less every part of the private sector is showing employment gains. Significantly also, the employment gains have been in full-time employment. So the growth of full-time employment is pushing somewhere towards 4%. And that's pretty positive for income growth as well. Looking ahead, kind of with the current trends fairly favourable, and with the outlook for kind of job-rich domestic demand pretty favourable as well. We now forecast solid employment growth in 2016 again, and for that growth to moderate slightly in 2017, and that should continue to push the unemployment rate down. And that will be kind of a big support, we think, to growth going forward. So that basically summarises, I suppose, our latest forecast. So I'll turn to Gabriel now.
Thank you, John. So the picture that has been painted by John regarding the forecast is clearly one of strong growth. It's only set to ease moderately in 2016, 2017. It's growth that is broadly balanced in terms of domestic demand and foreign demand, and it is employment-rich growth. So it is a fairly benevolent scenario. It's one, certainly by comparison to international standards, growth rates of this kind are very high, and even by respect to the past standards of Irish growth, it is a very good performance. To some extent, as John has pointed out, some of these elements that are underlying the growth represent a rebound from a period of earlier weakness. So during the crisis, households may have postponed expenditure, and now they are catching up on that. But a question when we observe the growth that we see in the projected in our forecast, what does that imply in terms of the cyclical position of the economy? Is it a situation where we might want to get worried about possible overheating of the economy, or is the growth inadequate relative to the potential growth? I think there we can say, if we look at our current forecasts, our assessment is that there is still sufficient spare capacity in the economy to accommodate the sort of growth we're envisaging in this forecast without encountering major constraints. And I think this is especially true in regard to the labour market, where despite the fall in unemployment that we have seen, that I think does not necessarily pose a disequilibrium sort of problem. Now, when we set this growth in the context of what has happened in the economy over the last, let's say, 10 years, it's evident that there have been very significant improvements. For example, in the public finances, for example, also in private sector balance sheets. So just to give two statistics, if we look at the public sector, the debt to GDP ratio has fallen from a peak of 120% to below 100%. For the private sector, if we look at the household debt has fallen from a peak of over 200% of disposable income to around 170%. So we see very significant improvements in public and in private balance sheets over the periods. Now, the prospects, as outlined in this forecast, look good, but there are vulnerabilities remaining. The first point we should bear in mind is that although they have improved, debt ratios are still high. The public debt ratio now is high relative not only to what it was in the past, but also relative to what is available in other countries. The same situation applies with regard to private debt. It improved a lot, but the ratios are still high. So this is still a highly indebted economy. That means the economy is vulnerable in some ways to adverse shocks. We also have to bear in mind that some of the factors which have driven growth may not last forever. The obvious one is oil prices. We cannot necessarily expect them to keep falling at the rates we have seen in recent years. Also, some of the catch-up elements will eventually exhaust themselves. So that is an element which is embodied in the forecast. But the other point, and the third point, perhaps the most important point, is that the risks to the forecast are to the downside. Certainly the external risks to the forecast are to the downside. The forecast is a central scenario. It is what we think is the most likely outcome given the available information. But there's a lot of uncertainty around these forecasts. And at the present moment in time, the evidence, as Luca has pointed out, certainly on a global perspective, is that the risks are to the downside for the global economy, related to China. Of course, the uncertainties about the future evolution of the Chinese economy. But it's not just China. If we look at the other emerging market economies, there are obviously very significant downside risks there as well. Another source of risk to the economy, of course, is coming from financial markets. We've seen significant falls in stock prices so far this year. We've seen a lot of turbulence in oil markets and in the foreign exchange markets as well. So there are a lot of risks to this forecast, and they are, from the external point of view, on the downside. So against that background, I think I would say our main message today is that the strong growth outlook provides an opportunity to tackle the remaining legacies of the crisis and to minimize future risks to economic, fiscal, and financial stability. This opportunity needs to be taken. Reducing the remaining vulnerabilities in the economy and strengthening economic resilience are necessary to mitigate the risk of future boom-bust cycles and to ensure stable and sustainable medium-term growth. Thank you very much. We're ready for your questions now.
Thank you. So we got a first question. Arthur Beasley, Irish Times.
Gabriel, what specifically do you mean when you say, when you reference the necessity to strengthen resilience? We're in the mouth of an election campaign in which there's a lot of debate already around the fiscal space, the availability of fiscal space, and what is going to be done with it vis-à-vis tax cuts and spending increases. What would you say?
Well, I think on the fiscal side, our message would be, in essence, as the very minimum, one should adhere to the fiscal rules that are set out in the Stability and Growth Pact and in the domestic fiscal framework. These should be absolutely fine. We would also suggest, if there is scope for doing so, that it could be possible to do a more ambitious adjustment than what is envisaged by just minimal compliance with the rules. That is, again, an element of choice. We think, given the vulnerabilities that are present in the economy and the risks that the economy face, it is a good idea to take advantage of these favourable opportunities and build up as many buffers as can be built up. Just to give one example, I mean, in the event of a sort of adverse downturn some years down the road, if we have built up fiscal space, you'll be in a position to take some counter-cyclical fiscal policy when the economy actually needs it. So it will contribute to stabilising the economy rather than destabilising it. Thank you.
Colin McCappy.
Can you just ask about the external environment? You talk about the adverse downturn or possible adverse downturn. A lot of forecasters in the last couple of weeks have given a pretty bleak assessment of what's ahead of us, including RBS, in terms of the fact that it could be a cusp of global recession. Do you believe that is credible? How worried should we be about that environment?
Luca, do you want to take that?
Yes. There is a considerable uncertainty. There is uncertainty from the financial side, there is uncertainty about the numbers, there is uncertainty about what the connections between, for example, changing monetary policy in the United States and to which extent it may affect other emerging market economies, especially those that have a high level of debt in dollars, for example. So the uncertainty is extremely high, but let's say the news that we have received since December all seem to point into the same direction, almost all of them. So it's very hard to give a quantification of what's going to happen. These are global phenomena and they actually involve several set of countries, several set of policies. But I would definitely say that the numbers as we have shown them today are subject to a clear downward risk. And let's say if one would do some kind of back on the envelope accounts, these numbers would be already lower.
David Murphy.
Gabriel, when you're talking about more ambitious steps to work on the public finances, are you talking about cutting the deficit? Are you talking about paying back debt faster? What specifically are you talking about there?
Well, I think the two are linked. Obviously, the evolution of the debt ratio depends upon the deficit and the growth rate. So essentially, it's linked mechanically. We would suggest that, the fiscal rules basically are in terms of, under the preventive arm of the Stability and Growth Pact, the fiscal rules are formulated in terms of the change in the structural balance. And there is a minimum adjustment that is set out there that in order to meet the rules. Our argument would essentially be, if it is at all possible, given the risks that the economy faces at the present moment in time, to go for a more ambitious, a faster pace of deficit reduction, which would imply, of course, a faster pace of debt reduction.
Dara Doyle?
Luca, just to be clear, you talk about clear downward risk, you're talking about the Eurozone economy, global economy?
I'm talking specifically about the global economy and the Eurozone economy, which is a non-negligible chunk of it. Let's say if you want some more information about what this implies for the Irish economy specifically, you should probably ask John.
Actually, it's a question for Gabriel and John. Any concerns about how political instability or uncertainty would affect the Irish economy? Obviously, you don't have a comment on the election, I'll look into that. Looking at the polls, we can see an uncertain time coming after the election. So, in a hypothetical situation of political uncertainty, how might that affect the economy?
Well, there is an extensive economic literature which addresses the issue of how uncertainty impacts on the economy, also how political and policy uncertainty impacts on the economy. And the evidence there is that such increases in uncertainty are negative. They're bad for growth. They lead to weakness of growth. They induce companies to postpone investment, consumers to postpone household consumption. Now, in the Irish economy, in particular case, correct me if I'm wrong, John, but as far as I can see, we don't have any evidence that political uncertainty is affecting the economy. For example, if we look at bond markets, the spreads vis-a-vis Germany, there's no evidence there of a political uncertainty effect coming in. I think if we look at some of the other indicators that we look at. So as of now, at this moment in time, we don't see evidence of political uncertainty affecting the economy.
But clearly after the election, that's when this will...
Well, of course, markets will always look ahead, so it's not that they will just... but they will, of course, respond. But again, all I can say is what we see in the data now, and we don't see it. But you're right. If there was a lot of political uncertainty in after the election, we should expect to see adverse impacts on the economy.
Okay, do we have any further questions?
On corporation tax receipts, could you just run through the? I think in the opening statement you said over half is to do with profits. Could you just go through what the other half was? The 2.3 billion.
Yeah, we have a box in the bulletin which I can just refer to. So it's box D in the domestic economy chapter. It's on page 26, and it goes from page 26 to page 28. So what we're looking at there. So kind of one of the things we struggle with ourselves is trying to kind of forecast revenues. So some of the economists kind of in the division took a look at this and looked to see kind of the extent to which they could relate the growth in corporate profit tax, corporation profits tax, to fundamental factors. And what they found was that there is a reasonable relationship between the evolution of corporation profits tax and the industrial production index for the ICT sector. So they looked at a number of things. They looked at the overall industrial production index. They looked at some other measures, but what they found was that the best measure was the industrial production index for the ICT sector, and they found that explains around half of the increase in corporation tax last year. Now, obviously, as you say, it leaves the other half as to kind of what, kind of where is that coming from. Their work doesn't shed light on that. It could possibly be something that they're not necessarily capturing here, or it could be because of some shift in the relationship between profits and taxes paid. But the evidence here is that a little over half of it kind of is explained kind of if we look at what's going on in the ICT sector. Now, they looked at pharma as well. They looked at a kind of a composite measure between the two, but what they found was the ICT one kind of gave them a slightly better fit in terms of the econometrics.
And just one final point on house prices. Does your, I know you give me the forecast house prices I'm going to refer to, is the evidence out there that actually credit controls should be strengthened instead of not weakened? That the industry, a lot of the industry are actually coming forward given the supply constraints.
When you say credit constraints, you mean our macroprudential measures, LTV, LTI ratios. Well, as has been announced already by the Governor, there is a review which will take place, and we expect to be able to report the outcome of that review in November of 2016. So basically, I think pending that review, it's far too premature to say whether a particular indicator points in this way or the other way. I mean, the point we're trying to do, what we will do is based on a wide range of data, including data supplied by the banks specifically for this purpose, we will try to assess the impacts of the measures. Now, once that assessment is made, there may or may not be an issue of recalibrating the rule. And as the Governor has stressed, two things. One is it will require quite a high evidence threshold to warrant a change, and secondly, that any such change could be in either direction in terms of tightening or loosening. But at this point in time, I don't think we can have anything to say beyond that. Yeah?
Can I just go back to this question of the fiscal space, right? Because it seems to me that the fiscal space as suggested in the calculations of the Department of Finance, for instance, right, that arises after a conclusion that targets have been met under the new fiscal rules, right? In the election campaign, it seems that the parties who say they will comply fully with the rules are deploying the entirety of the fiscal space for their tax and spending projections. What you're saying, and correct me if I'm wrong, is that some of that fiscal space, that largesse, if you like, should be deployed for debt reduction or further deficit reduction. Is that what you're saying?
We're saying that the serious consideration should be given to using that space, given the serious problems, the vulnerabilities that the economy faces. I think that's essentially our message. It's a qualitative message. We're not saying about specific fiscal measures, particular tax instruments, particular government spending, but we're saying the economy there are vulnerabilities remaining, there are risks, and one should be prudent in terms of using that fiscal space.
That's a message to all parties.
It's a message, I think, to not just to parties. It's a message to the country as a whole, to the voters, and the society as a whole. You know, the essential idea is that we've done a lot of progress. Tremendous achievements have been made on the fiscal side, but be careful. There are risks out there. There are vulnerabilities there. So be cautious and be prudent. That's essentially our message.
Was that prudence demonstrated in the last budget?
I don't think I want to get into a detailed fiscal assessment of specific budgets. Nowadays, in our institutional structure, we have the Commission, who is responsible for monitoring compliance with rules, and we also have the Irish Fiscal Advisory Council, which is also responsible for monitoring the rules. So that, if you like, the institutional division of labour is there. We would basically defer to the judgments of these authorities, which have the responsibility for these tasks.
Okay, thank you very much. Do we have any final questions? I don't think so. Okay.
One last question.
Thanks, Mayor.
Sorry, Jill. Just to pick up on the mortgage rules, you said that that they could be adjusted either way, which you're saying that they actually could be tightened.
That's what the Governor has said. It's not what I'm saying. I'm simply reporting what that is the position as set out by the Governor. So there is a symmetry. You review the rules, you assess whether they're working on the basis of the information that you have, an extensive amount of information, both in terms of data provided by banks, loan level, macroeconomic data, and so forth. You say, are the rules achieving their objectives, and are there side effects that are unwarranted? And then on the basis of that, you would say whether the rules need to be adjusted, recalibrated is the relevant term. But again, as the Governor has stressed, this is a permanent feature of the Irish housing market, and in order to change some of the calibration, shall we say, of the rules, it would require a high evidence threshold.
And something everybody's focused on possibly that the rules could be tightened, all the focus on possibly loosened.
Well, I mean, if you look at what the governor said, it's very clear that there should be no expectation necessary on the basis of the information we have now. There could be no expectation in that regard.
Okay, Colin, final question to
Very
Colin.
quickly,
Thank you.
sorry, just on what Luca was saying again on the impact on Ireland in terms of the global.
Sure.
How insulated are we?
Well, if you look at there's significant uncertainty, so it would depend, for example, on the extent to which, if global growth was to ease, the extent to which it eased and how long that might last for, or if there were tensions in financial markets, how long those tensions might persist and how they would transmit. Now, if you look at the channels through which they'll tend to affect us, like we've seen, if you like, over the past year, the benign impact of lower oil prices in terms of what it's done to inflation, the boost to purchasing power it's given. Given where oil prices are now, the likely further falls in them, or the falls we've seen, are pretty small, so the macro consequences of those may not be great. They could have some impact in lowering inflation, for example. So if it was to lower inflation, instead of seeing 1%, we might see inflation a little bit below 1%, say, this year. That, depending on how people look at it, it would depend on what that would do to real... It might give some small boost to real incomes, but then it would depend on whether people spend it, or they tend to save it, or pay off debt. The key then would be, say, exports. But if you look at the performance of our exports in recent years, typically, say, going back, we would tend to have thought of broadly a kind of a one-for-one or nearly one-for-one relationship between exports and demand in trading partner countries. Now, in recent years, exports have grown much more strongly. Irish exports have grown much more strongly than demand in trading partner countries. So if there was to be some weakness at the international level, that could feed through, and probably would feed through, into some lower level of exports. But our export performance has been unusually strong, so you couldn't read it through. You wouldn't at this point read it through directly. We'd have to see what happens there. And then obviously there would be some offset, because a lot of what we import essentially is for processing into exports. So there would be some offset there. So we would wait and see really what happens. If this is to persist, we'll have a clearer picture in a kind of a month or two where we are. But for now, we won't put a number on it. Cheers.
Okay, thanks very much, everybody.
Jill, sorry, I just wanted to briefly refer. There's 2 articles in the bulletin this time, so we just normally make mention of them. So just to refer briefly, there's an article on interconnectedness in the Irish banking sector, and the interconnectedness of the Irish banking sector with the global financial system by Niamh Halsey from the Financial Stability Division. It's on page 66 of the bulletin, and it looks at the interconnectedness of the banking sector with the broader financial system using kind of regulatory data. By interconnectedness, we mean essentially between the links between banks and other parts of the financial system. And there is some interesting findings in that. We can see that interconnectedness can have both positive and negative effects. It can be a shock absorber for smaller shocks, but a shock amplifier for larger ones. What the article finds is that domestically focused interbank large exposures are much lower than those of internationally focused banks relative to the size of the assets. And that internationally focused banks are primarily exposed to other credit institutions, whereas domestically focused banks are typically more exposed to households and corporates. So there's some interesting material there. And the second piece, which is on page 61 of the bulletin, is an information note prepared by our colleagues from Banking Resolution on the new resolution framework. So it's entitled Resolution Planning for Credit Institutions and Investment Firms. So it goes through the changes that have come through from the transposition of the Bank Recovery and Resolution Directive into Irish law, and from the designation of the Central Bank as the National Resolution Authority. So it contains some information on there on that framework and how that framework works. So I draw your attention to that, so thanks for that.
Thanks very much. And as I said at the outset, the interconnectedness article, there is an interview with the author, Niamh Halsey, on YouTube as well, so please take a look. Thank you very much.
Thank you.